Welcome to Tax Intelligence, presented by TaxOps. I'm Marc Gordon, head of state and local tax.
And I'm Lindsay Haskell, the head of the corporate tax practice here at TaxOps. Today, we'll be having a conversation about state nexus. We're here to help finance leaders navigate the increasingly complex world of tax, including federal, state, and R&D, without losing their minds or their budgets in the process.
Today, we're diving into a topic that keeps CFOs up at night more than a surprise audit, and that's Nexus. It's the tax world's version of the butterfly effect. A laptop in a home in Boise or a few dozen sales in New Jersey can ripple through your entire balance sheet.
That's right. It's no longer just about where your widgets are. It's, we're living in this post-Wayfair economic threshold and the remote work expansion world. Your tax footprint is probably much larger than you actually think it is.
We're going to break down what triggers Nexus, why ignoring it is a strategy that usually ends in tears, and how to use VDAs to clean up the past so you can focus on the future. Let's get into it.
Great. Thanks, Marc. And to start out here, what I wanted to do was ask you just some really basic but really important questions that I get from clients all the time. The first question just being, what creates Nexus in a state?
Yeah, so Nexus is a business's connection to a state, and it's important to keep in mind that a business must have substantial nexus with a state for that state to be able to assert tax. And really what we're worried about here is both income taxes and sales taxes. And so back to your question on what creates Nexus. There's really kind of two buckets that create Nexus. And that's physical presence, and then the concept of economic nexus. So physical nexus, pretty self-explanatory. If you have property or payroll or performing activities of any kind in a state, that's likely going to trigger both income tax and sales tax nexus. There is something called Public Law 86-272 that has somewhat of a narrow application to sellers of tangible personal property. This only applies to income tax. However, there's a certain list of activities that if a business conducts within a state may be protected by Public Law 86-272. So, actively being in a state may or may not truly trigger physical nexus in this narrow window. However, the important thing to keep in mind there is that Public Law 86-272 has continued to get chipped away at. Most recently, there has been guidance that certain internet cookies can basically blow your Public Law 86-272 protection. So if you are a seller of tangible personal property, you should understand these new rules and how your website may be creating nexus within a state. And so that covers physical presence. The other bucket, economic nexus, we kind of look at income tax and sales tax separately through this lens. And maybe we'll start with sales tax. It's the kind of easier one to go through. So going way back, sales tax was only asserted through physical presence. And similar to Public Law 86-272, there was a doctrine that kind of protected a number of de minimis activities in a state that a taxpayer could perform, like visiting trade shows, kind of these short-term one-off activities that wouldn't really develop that connection between the business and the state. And with the kind of birth of the internet and e-commerce, all of a sudden, as brick and mortar retail shifted to e-commerce retail, state sales tax revenue plummeted, right? Because these internet companies, did not have physical presence in most states. They were just shipping goods, which is one of those activities that's protected that, isn't going to trigger physical presence unless you're delivering goods with your own, company trucks, let's say. Unless those goods are delivered with your own commercial trucks. So states started on the sales tax side challenging where these e-commerce retailers had a presence in their state. And it worked its way all the way up to the Supreme Court, which is the, Wayfair versus South Dakota Supreme Court decision. And this really was a landmark case for sales tax. It set a bright line threshold that if a business has $100,000 in the state or over 200 separate transactions, that triggers economic nexus for sales tax purposes. So that court case was in 2018. It took quite a number of years for states to slowly start adopting this. And at this point, the landscape is every state with a sales tax has an economic nexus threshold. And just a quick note, there are 5 states that do not have sales tax. And do you know what a good acronym is to remember that by, Lindsay?
I don't, Mark. Can you tell me?
I can. I heard this from an old boss while I was interning. It's oh damn, no sales tax, and that's Oregon, Delaware, Alaska, Montana, and New Hampshire. So there is an H, I guess, at the end of oh damn, but it's a good one to remember. So I think the main takeaway there for economic nexus on the sales tax side, we have this bright line test. It's very clear. A number of states are starting to move away from the 200 separate transaction threshold. I think they started to realize that, certain businesses have a high volume of transactions that are low dollar. And so they don't want to be creating this compliance burden kind of unnecessarily. Probably, some of the more reasonable states, let's say. So sticking on the topic of economic nexus, we kind of have to reframe it on the income tax side because that Wayfair Supreme Court case, that applied to sales tax. It does not translate over to income tax, even though we have this similar concept. So the majority of states that impose an income tax, and I don't have a fun acronym for the states without an income tax. I'll have to work on that. But there are kind of 2 buckets. The general framework for these states with an economic nexus threshold is it's called a doing business standard. And ultimately what that means is as a taxpayer, are you establishing and maintaining a market of customers in that state? It's very vague. States have a hard time asserting economic nexus on the income tax side as a result. And so the growing trend that we've seen, and there's probably about 15 states that have gone this route, is they have, similar to Wayfair, established a bright line test based on your apportionment factors, so property, payroll, and sales in a state. That if you cross that threshold, similar to sales tax, boom, you have economic nexus. And we like working with those states because it's, very cut and clear. Maybe just a quick note on property and payroll. Those threshold tests for income tax purposes are kind of irrelevant because physical presence, in addition to economic nexus, can, create this connection with the state that allows them to tax. So if you have property or payroll in a state, it really doesn't matter how much you have. You likely have physical presence nexus. So we don't even really need to address economic nexus at that point. So to kind of conclude there, nexus is kind of like dating. Physical nexus is when you leave a toothbrush at their house. And economic nexus is when you spend so much time texting them that the state decides you basically are common law married.
That's a very good analogy. And I agree on its simplicity. First and foremost, telling clients that just that physical presence really, no matter the dollar amount, it triggers that nexus. I mean, there's always a way to talk about kind of cost benefit of how that actually applies to your business and the, let's just say the extra, right, compliance burden, which is what I get a lot from our clients. But that physical presence obviously being, from what I'm hearing from you, just that easy starting point of, looking at your nexus footprint or where your footprint is. And that's where, comment back to, kind of the old school rules of physical presence were pretty easy. Now new day, post COVID, this remote workforce has really, I think, expanded that. From what I heard on you on the, kind of more the, sales, nexus or threshold nexus, economic nexus, it looks to me that sales tax, you're looking at that Wayfair kind of case or expansion. From an income tax perspective, feels like it's a little bit more of an analysis, right? Or, a little bit of a more of subjective analysis state by state, which can get pretty confusing, I think, for a lot of companies out there.
Yeah, subjective is the right word for sure on the income tax side. And, that's where it gets interesting and we can really help our clients plan and strategize around their state footprint. Because I think the important thing to keep in mind is you may have triggered Nexus, but what's the impact there? On the sales tax side, yeah, you might have triggered Nexus, but you might not be making taxable sales that are subject to sales tax. On the income tax side, you might have triggered Nexus, but you might be in a taxable loss, or you don't actually have any sales in that state, and that state is a single sales factor state, so you wouldn't even source revenue to that state. There can be some
Right.
other pitfalls in there, but the buck doesn't stop at the Nexus question. I think there's downstream impact that begs the question: how do we look at this?
Right. And I think you're even answering a few of my next questions where, I think we covered off what taxes does Nexus apply to. Mainly, you're going to be looking at sales tax and income tax. Obviously, I think payroll tax just comes hand in hand with where your employees are. So we'll sort of skip that part of the conversation. But back to both sales and income tax. Okay, so we've triggered Nexus, or we've triggered Nexus, we think, in prior years. Now, what do we do? How would you approach that with clients? And maybe it's different for each client, but, how would you just approach that question of, we think we've triggered Nexus in prior years?
Yeah, I would say the size and sophistication of the client definitely weighs on how we would approach that situation. Just our basic information gathering is going to be looking at where is the property, payroll, and sales. How on the income tax side, how we apportion the income, and really a big part of the story is where are the sales. That's kind of what's triggering economic nexus on the income tax side, and you can very quickly on the sales tax side see where you could potentially have issues. From there, depending on how far it goes back, you want to look at data from all those periods and kind of start weighing, you enjoy working on provisions and state provisions. Think of it like building a state provision model at that point. We are modeling the state income tax calculations for these states that you may have nexus in. And from there, we kind of have a story on what that exposure looks like. And that kind of dictates the decision on how to proceed in terms of filing on a go-forward basis or maybe trying to go and back file returns to become fully compliant.
Well, that brings me, I guess to your point, I guess what you're saying about modeling, right? And you're commenting, yes, I spend a lot of time, building out models or looking at tax provisions or tax returns, or forecasting modeling. It sounds like this is a little bit of an exposure modeling, if you will, kind of a prior year, look back. How far back would, from a state perspective, understood that every state is different, that's a common theme, but, what do you recommend on that look back period?
Generally, I would say 3 years.
Hmm.
The unfortunate aspect of it is if a business has nexus in a state and they haven't been filing, the clock on the statute of limitations has not started to run. So, in general, there's situations where it could go back 10 years, which then gets into some data issues, right? Tracking how far back can you really go? And so I think, something we'll discuss shortly is states have certain amnesty programs, generally called voluntary disclosure agreements, that allow you to go back and limit some of that look back and limit penalties that may apply.
Yes, that was actually my next thought is, okay, we know we have exposure. Well, we know we have triggered nexus, right? And maybe we're looking at sales tax or income tax or both. We know of it, we have exposure. Started to put some pen to paper on a look back period to understand what that exposure is. what is then the most strategic plan, right, to try to get it cleaned up? What are our options? I mean, obviously, it probably depends on what that exposure really looks like. Maybe you're looking at it under more of a audited financial statement process. Maybe you're looking at it more from a, tax return compliance, cleanup process. But, there's exposure there and it's material. So what is our best avenue for, getting that cleaned up and, from both a risk perspective, but also like, let's not try to break the bank, why we do this.
For sure. There is a balance between kind of managing that exposure and the filing compliance that may come along with, truly addressing, dotting all the I's and crossing the T's as far as income tax filings go. And sales tax filings, I would say, those should generally be taken care of just because the exposure can be kind of topless in a way. I think the best way to kind of tackle some of those exposures, depending on the magnitude of that exposure, is one of these voluntary disclosure agreements. And the other day I had a client actually give a great analogy on this. She said, we were, talking about voluntary disclosure agreements, and she goes, if I was speeding, why would I pull over to tell the cop I was speeding? And I told her that's a great analogy. I've never heard it put that way before. I'm stealing it. And then I went on to add that it's not really about when you're speeding. It's when you have a dead body in the trunk and you need to go, take care of this dead body. So it's that get out of jail free card when you really need it.
Right.
The other aspect there, I think a lot of the due diligence consulting around transactions, a lot of the times it's sales tax issues that are coming up, and the buyer wants those issues wrapped up either before the purchase can close, or they want to build in some sort of liability to carry forward so that they're not paying out of pocket for some of these sales tax exposures. So I think a lot of the time where we see VDAs pop up is for smaller amounts rather, is when a transaction is happening and one business is trying to get all their loose ends tied up. Back to the analogy, you don't want any loose ends. So,
yeah. Well, it sounds like too a VDA, it maybe solves two issues. One is it also puts a stamp, right, on that like where we were talking about the look back period, and really if you've triggered Nexus, you're possibly looking at, you've never actually started a statute of expiration, so you could have a 10-year kind of exposure period. Sounds like a VDA program at least kind of limits that to, I mean, I'm sure again it's different per state, but 3-4 years, whatever it is. And then I obviously I think it also helps with if there is a larger exposure amount, that penalty abatement. I mean, that's sort of the asking for forgiveness part of it, right? Where you're still going to be liable for the tax and interest, or I believe interest, but maybe you're at least getting out of some of those penalties because you have kind of gone to the state to ask for forgiveness as you've kind of identified the issue.
Yeah, the other thing to keep in mind in terms of whether or not to complete the VDA is, let's say you don't want to worry about past exposure. Maybe it's small, and you like to live dangerously and don't want to deal with it. You need to ask yourself, okay,
speed. You like speed.
I like to go fast. And you don't want to deal with the past exposure, but you do want to start filing prospectively. You don't want it to get bigger, or you're going to start doing more business in that state. So you don't want it to get bigger and go, just not be addressed. The question to ask yourself is, what does a state do when you file an initial sales tax return? Mm-hmm. Are they going to reach out and say, hey, it's great you're doing business in our state. Thanks for signing up.
When did you start doing business?
Or they will send you a Nexus questionnaire and say, when did you start doing business in the state? And I mean, at that point, you are kind of SOL on the VDA. VDAs normally need to happen before a taxpayer has received any contact from a state, either a notice or maybe that taxpayer proactively registered in the state. They're in the system. You normally can't participate. So that is part of the game to keep in mind as well, is if you are going to file prospective, what is the likelihood this nexus questionnaire, the question might come up is, when did business start in the state? Because then your hands are kind of tied. So
Right.
that's part of the risk on both sides of it.
Right. Well, you bring up another good point. I'll say that I get kind of asked about a lot with clients, is, I mean, even going back to the physical presence, like, you've hired one remote employee in a new state, it's one employee, and I go to the client and say, well, you have to file, state income tax, and you probably should be looking at some sort of sales tax there as well. You have physical presence in the state. And the number one question I feel like I get back is, how are they going to know? How is the state going to know, about that one employee sitting there? And I mean, I'm sure you have your answer, right? But you're filing a payroll tax, filing in that state, or you're probably registered for unemployment, or you've kind of registered with the state on some aspect to get that employee up and running there. But how do again, how do you, obviously you still come back to that cost benefit, but how do you look at that, or what happens if a state does find you? What are the next steps there?
Yeah. I guess when we were talking about analyzing the risk earlier, having an employee in a state is kind of one aspect of that risk portfolio in terms of what's the likelihood that a state is going to identify an out-of-state business. As you mentioned, if you have an employee in the state and are doing payroll taxes correctly, if you're using an ADP, they're going to be on top of it. They're going to be paying those taxes for you. There is the chance that the state's Department of Revenue, the Secretary of State, the Employment Security Department, or kind of the respective departments of those nature per state, may talk to each other. Where I've seen this come up is specific to California. I'm sure other states, kind of have this capability and are on top of it, but California is very aggressive with it. I had a client who had one of their employees moved to California, didn't tell management, updated their employee profile so ADP knew. So ADP was paying California withholding $3,000 of payroll. California came after them, no sales in the state, all for an $800 minimum tax filing fee. So, I think that highlights two things. Your case point on having an employee in the state, and two, sometimes there's exposures that are so small. Do we really care about them? And that's probably this, the $800 bucket. And so
But
I
the
think,
state could still find you there. I mean, that's what's interesting about it for $800. That, yeah, yeah.
yes, yeah. Those are the painful ones to deal with from an administrative perspective. But I think the other thing to keep in mind with payroll in a state is, especially if we're talking on the income tax side, that normally is more indicative of a prospective, hey, let's start filing, let's get compliant. And oftentimes, I mean, in addition to income tax returns, if you have an employee in the state and you're doing business in a state, that entity really ought to be registered with the Secretary of State. And those rules can be dependent on the specific state. So we advise, clients talk to their legal or registered agent on that matter. But, likely there's some other holes to be filled up as well when you find out you have payroll in a state and haven't really been addressing that correctly.
Right. Great. Well, I'll kind of end with maybe my last quick question is, how do you see the pros and cons of a VDA? Just leave everybody with sort of those last couple bullet points on, again, where we've started, right, is we know we've triggered Nexus. We know we've got some sort of prior year exposure. Maybe it's across multiple states, maybe it's a handful of states, maybe it's both on the sales tax side, but also on the income tax side. And, we've kind of got that all nailed down of where, what, and, why maybe I'll say, but then what are those pros and those last couple bullet points you'll give to companies on going the VDA route or going the prospective route, and just to just again to give people a couple last minute comments on how we would analyze it at TaxOps for our clients.
Yeah. Yeah. I think we've touched on a lot of the benefits. So to recap those, you get the penalty waiver. That can be huge. That's anywhere from 25 to 50% of a liability. And, sales tax exposure can already get really high, and tack on 25 to 50% can be very steep. So, the larger the liability, the more benefit a VDA presents to a taxpayer. The other big point, limited look back, shaving off 10 years versus shaving off 2 years. The 10-year, that seems like a no-brainer. Let's do the VDA, get 3 or 4 year look back. 2 years, we can waffle on that decision. We have another year. We can always do the VDA for this back period if we don't find out. And it, again, goes back to the client's risk profile and appetite for risk itself. And then finally, there's the anonymous aspect of it in a lot of cases. I know it's not every single, voluntary disclosure is anonymous, but it does give an upfront assurance that you can approach a state, present them with what you want to come forth with, and get that buy-in. Know that as long as you follow the process and guidelines the state has sent out, you're going to get the penalty abatement. You're going to get the limited look back. And then I guess final, and this is kind of a small benefit, but going through the VDA process really sets you up with a clean slate for when you do prospectively start filing. For sales tax, you'll have an account ID. You'll have your sales tax account ID set up. You'll have a lot of like the administrative items taken care of ahead of time, versus filing prospectively. You're starting from step one, need to go through all the administrative hurdles, kind of sunk cost. I guess you're doing it in both scenarios, but you can hit the ground running after a VDA. The kind of cons of the VDA, I would say, clients who like to live dangerously, it robs them of that joy. And then the other aspect, there are fees incurred with getting caught up, depending on the volume of filings. So I think how you need to look at it there is ask yourself, how is our business footprint going to change in the next 5 years? Is it going to shrink or grow? And if it's going to shrink, maybe or shrink or wind down, let's say even. You're winding down. You're done. You're going to cash out. Maybe you don't want to go to the VDA route. Maybe you're more comfortable letting sleeping dogs lie. Or if you're a growing company, you're expanding, you're going to be hiring people in a bunch of different states, the sooner you can get your house in order, the better, right? Mm-hmm. Set a good framework for compliance moving forward. So those are kind of your big pros and cons to think about with a VDA.
Well, that makes sense. I mean, it doesn't sound like it's a get out of jail free card by any means, or back to your, why would I speed and then pull over and kind of admit things, analogy. But it definitely sounds like there's a benefit there of, again, if the exposure is pretty, large in certain states, then at least you're not kind of paying double. You're not paying that penalty exposure, and you're kind of getting on the up and up going forward. But definitely there's a cost component, obviously, to the VDA itself, of course. So it sounds like it really just goes back to that cost benefit analysis of, again, back to, you've triggered Nexus. Where have you triggered Nexus? What are those exposures? Maybe there's even some states you choose to do the VDA, and there's some states you choose to kind of go prospectively. It doesn't have to be maybe a one size fits all, with that type of analysis. So, but I think, yeah, there's definitely something to be said about doing VDAs, and also maybe not doing VDAs, as of course, as we tax people always like to say, there's it seems to be that there's never one answer or never one solution, that fits every question out there. So it just sounds like something you'll want to talk to your tax advisor about, talk to, figure things out internally and kind of weigh everything as you go going forward.
Definitely. And I mean, that's how we approach it with our clients is we want them to understand the risk and all the decisions that, are available to them and, kind of recommend a path forward. And generally that's to be compliant. But I think we respect the fact that there's times for a strategic approach to be applied. So.
Right. Well, if today's conversation sparked a little bit of a realization out there with you, don't panic. I would just go through the process of, sort of quantifying that exposure that you have. Look at it from all states, look at it both from sales tax and income tax perspective first. And then, like I said, reach out to your tax provider or really reach out to TaxOps, of course, if you ever find yourself needing help in this area.
Yeah, thank you for tuning in to the inaugural episode of Tax Intelligence presented by TaxOps. Until then, keep your filings current and your Nexus in check.